Insurance fraud. The Insurance Information Institute estimates that fraud accounts for 10% of the property insurance industry incurs losses and loss adjustment expenses are about $30 billion a year. This fraud results in higher premiums. Fraud may be committed at different points in the insurance transactions by different parties. Common fraud include padding or inflating actual claims, facts on an insurance application, submitting claims for injuries or damage that never occurred, and staging accident. Prompted by the incident of insurance fraud, 41 states and the District of Columbia have set up fraud bureaus. Some bureaus have limited powers, and some states have more than one bureau to address fraud in different lines of insurance. These agencies have reported increase in referrals, tips about suspected fraud, case opened, convictions, and court-ordered. Insurance fraud can be hard or soft. Hard fraud occurs when someone fabricates claims or fakes an accident. Soft insurance fraud, also known as opportunist fraud, occurs when people paid legitimate claims, for example, or in the case of business owners, list favor employ or misrepresent the work they do to pay lower workers' compensation premiums. People who commit insurance fraud range from organized criminals who steal large sums through business activities and insurance claim mills to professionals and technicians who inflate the cost of services of charge for services not rendered. To ordinary people who want to cover their deductible or view filing a claim as an opportunity to make a little money. Some lines of insurance are more vulnerable to fraud than others. Healthcare workers' compensation and auto insurance are believed to be the sectors most affected. Insurance fraud received little attention until the 1980s, when the rising price of insurance and the growth in organized fraud spurred efforts to pass stronger anti-fraud laws. Allied with insurers were parties affected by fraud, consumers who pay higher insurance premiums to compensate for losses from fraud, direct victims or organized fraud groups, and other medical professionals who are concerned that their reputations will be tarnished. 1 out of 5 Americans think it is acceptable to defraud insurance companies under certain conditions, according to the Against Insurance Fraud. The organization released the findings in a 2008 study, The Four Faces of Insurance Fraud. It found that the public is consistently more tolerant of specific insurance fraud today than it was 10 years before. In addition, studies by the Insurance Research Council show that significant numbers of Americans think it is all right to inflate their insurance claims to make up for insurance premiums they have paid in previous years when they have had no claims, or to do paid a claim to make up for the deductible they would have to pay. Insurers must preserve the fine line between investigation, suspicious claims, and harassing claimants, and the need to comply with the time requirements for paying claim imposed by Fair Claim Practice regulations. All states have unfair claim settlement practice laws on their books to ensure that the parties involved are informed of the progress of investigations and that investigators settle the claim promptly or within a specified amount of time. About 19 states have provisions that provide guidance and protection of investigators by allowing time limit extension or waivers and detailing what evidence is required and to whom the evidence should be made available. Ensures anti-fraud measures. The legal options of an insurance company that suspects fraud are limited. The insurance can only inform law enforcement agencies of suspicious claims, withhold payment, and collect evidence for use in a court. The success of the battle against insurance fraud, therefore, depends on two elements: the level of priority assigned by legislators, regulators, law enforcement agencies, and society as a whole to the problem, and the resources devoted by insurance industry itself. To that end, most insurers have established special investigation units. These entities help identify and investigate suspicious claims. Insurers have also created a National Fraud Academy, a joint initiative of the Property Casualty Insurance Association of America, the FBI National Insurance Crime, and the International Association of Special Investigating Units. It is designed to fight insurance claims fraud by educating and training fraud investigations. If offered online class under the leadership of the NICB, the liability system and medical malpractice insurance issues. The tort system cost $254.7 billion in 2008 in direct costs, which translate into the $838 per person, and many billion of dollars more in direct costs. According to Tower Perrin's most recent tort cost study, U.S. consumers pay directly for the high cost of going to court through higher liability insurance premiums because liability insurance rates reflect what insurance companies pay out for their policyholders. Legal defense and any judgment against them, and they pay indirectly in high prices for goods and services since business pass on to the consumers the expenses they incur in protecting themselves against lawsuits, including the cost of commercial liability insurance. Beginning in the 1980s, in an effort to reduce litigation costs, business groups and others mounted a campaign to reform tort law. Tort law is the basis for the U.S. liability system. Most reforms have taken place on the state level, and during the last decade, all about a handful of states passed significant tort law reforms. However, some have been overturned by the courts. Many reform efforts have focused on medical malpractice issues. Medical malpractice insurance covers doctors and other professionals in the medical field for liability claims arising from their treatment of patients. The cost of medical malpractice insurance began to rise in the early 2000s after a period of essentially flat price. Rate increase vary precipitated in part by the growing size of claims, particularly in urban areas. Among the other factors driving up prices was a reduced supply of available coverage as several major insurers exited the medical malpractice business because of the difficulty of making a profit. New research suggests that premium increase may be moderating, but for any significant turn around to take root. Major reforms in the delivery of medical care that focus on patient safety